My first guest is Patrick Dimick, Senior Portfolio Strategist at Bridgewater Associates, one of the largest hedge funds managing approximately $123 billion in assets. And of course, Bridgewater has been doing deep fundamental research focusing on the macro environment for nearly 50 years. Patrick, it's so great to see you. Thanks for joining me in the studio today.
Thanks for having me.
Well, Bridgewater, not only does it span, several decades, but to me, it's really one of the most iconic hedge funds. And, I say that because as I was getting started, in the financial services industry, of course, the first thing you read is Ray Dalio's Principles. And, of course, during the financial crisis, we were all reading, how does the economic machine work? You leverage the economy, you then have to deleverage the economy, and that has pretty significant ramifications for the economy and asset classes. So, again, just, truly a thought leader in how the economies work. You guys are at Bridgewater, but you've been there for 16 years and you've seen a lot of different market cycles. So in your words, what has been Bridgewater's kind of key to success throughout all these different market cycles?
I think one of the keys is certainly focus. Like in many ways, Bridgewater is a simple firm to understand. We've always believed there's only two ways to make money if you're going to kind of leave the safety of T-bills or cash, and that is build a rock solid long-term asset allocation that can deal with whatever environment comes along in a reasonable way, and then of course make good tactical bets or deviations along the way. We think that's all there is, and because that's all there is, that's all we do. We work really hard on constantly improving our asset allocation strategy and our alpha or tactical trading strategies, and we don't try to be a financial supermarket to have the product that is hot or fashionable in the moment. So maintain that focus. And then if I could add just a little bit more on the reasons for the success, I think whether you're doing asset allocation or tactical trading, also critical to our successes, start with deep fundamental understanding of how you think the market economic machine works, rather than doing statistical, quantitative, backwards optimization type of approaches. We're very systematic. It's really useful when you get that understanding after doing the research to write it down into a set of decision rules that you're going to follow, because then you never forget any lessons learned. And then the last thing is just diversify. Like even if you have deep fundamental understanding and it's like deployed in this very disciplined and systematic way, you can only get your odds of being right so high. Beating markets is hard. Got to spread out the bets. And I think it's some combination of those things that have led to whatever success Bridgewater has had.
Yeah, well, it's fascinating, and I love the point about truly understanding not just the correlations and assigning some statistical significance to it, but really understanding the core drivers of why things work the way they do, and then applying a rule book, applying a formula. And as I've been in the financial services industry, my very simple playbook has been you look at valuations, you look at positioning, and you try to identify a catalyst. Obviously very simplistic, but the point being is there's a set of rules and a formula that you look at Bridgewater. Well, you are one of the top macro managers out there, and let's talk about macro. The macro environment that we've been in 2022, and we're now in 2023. It probably couldn't be any more different, whether it's rates, inflation, growth concerns, tech valuations. It is all flipped in a span of about 6 months. So what's your big macro view right now on rates, recession or lack thereof, inflation? And I guess the question is, why do you think the macro environment has shifted so much so quickly?
I think in a nutshell, 2022 was the year of the tightening. We would argue it was a historically aggressive tightening by the central bank, not just an average tightening. And so the environment of 2022 is all financial assets have to reprice to remain competitive to cash. So that's kind of like the market impact of the tightening hits first and hits fast. And for sure, we all noticed that. 2023 now, you shift the debate in the markets to what will be the impact on the real economy from the tightening. We all know, what's that central banking phrase? Monetary policy works with long and variable lags. Indeed. Okay, what's going to be the outcome this time? So 2023 is all about the markets betting on shifting perceptions of answers to important questions like, will this tightening create a recession or won't it? And right now the markets are pretty firmly convinced that the tightening they did last year that'll be enough to make the inflation problem completely go away, and we'll be able to avoid recession.
And that's the market view, right?
Yep.
But how do you answer the question about these long and variable lags? Are they still coming, or is the market right to say, well, maybe we don't have to worry about that anymore?
We're more in the still coming camp. We know that it takes typically, on average, 18 to 24 months for a big tightening to produce the bottom of the economic cycle. So we're probably halfway through that at this point. So yeah, we're more in the camp of it's probably coming, but it's been slow to come. And I don't mind telling you, we were a little too bearish on growth a little bit too early, for example. But when we look back at why that happened, I think the economic slowing has been slow to come, because in part of how much cash there was on private sector balance sheets from the response to COVID. Households, corporations had a lot of liquidity they could spend down, which with the benefit of hindsight, I think had a bigger effect on slowing the slowdown's arrival than maybe we would have predicted. But yeah, more in the camp of a tightening that big is going to have real effects that bite on the real economy. We think we can already see those cracks forming, and they were just a little bit slower to form this time for reasons that I think are understandable.
And maybe it's a 1.5 trillion of excess savings. That's the cushion that you were talking about that kind of prevented us from having a recession in 2023. But to just kind of put a fine point on that, do you think recession in 2024 is the base case?
That's our base case. We think recession's more likely than not. It's certainly avoidable. For example, if the central banks decided they weren't going to worry so much about how low inflation goes and how long it takes to get it there, they could choose to reintroduce liquidity and more easing in order to avoid the recession. We don't think they'll probably do that, and that's part of the reason why our base case is for some sort of at least modest negative GDP by the middle of next year, by the middle of 2024, and then where we go from there, deeper or not, is totally up to the policymakers on what they do when they see that growth, and do they feel constrained or free to ease.
Well, it all hinges on the outlook for inflation, of course, and we've sort of been, and I think I saw this from somewhere, the summer of disinflation has felt great for markets, and if you look at the economic forecast, they have inflation going sort of towards 2.4% at some point in 2024. Do you buy that? Do you think we get into the twos? And I guess the other question is, if we sort of flatline around 3%, do you think the Fed goes tighter, forces a recession to make sure we get to 2?
I'll take the first part first. We think the last mile of this disinflation back down to target is going to be the hardest mile. And what I'm referring to is, okay, inflation goes from peak of 8 or so down to 4 or 5 these days. And as you point out, markets are saying it'll continue lower. I think we know why the inflation fell as far as it did already. They're kind of the obvious candidates: commodity prices lower, housing market down, lots of supply chain problems getting fixed.
Food, fuel, all down.
All of that stuff points to inflation falling a lot. But again, that concept of the last mile, we think that takes a big unemployment rate cycle to get rid of the wage inflation to get to 2. So on your question, does Bridgewater think we'll be down at 2.5 in 12 months from now? We think probably not, because you need to break the back of the labor market first. Then you ask me kind of a much more interesting and harder question, which is, do you think the central bank will just kind of relax that whole goal of getting inflation down to 2? I think that's definitely possible if there's a lot of economic pain out there, high rates of unemployment, high rates of misery, and inflation isn't down completely to target yet. I could imagine them becoming a little bit more relaxed about whether there's really a problem with 3% inflation. What I don't think is going to happen is that they'll announce to us anytime soon, before there's economic pain, that they've shifted an inflation target, because there's no upside to doing that now. They don't have to.
Right. That's a really interesting perspective, that we sort of stagnate around 3%. The Fed is not just going to kind of be coerced by the market, to say, okay, we're happy with that. So it really requires economic pain, and the recession probably still comes first before the Fed may acquiesce to maybe pausing with inflation at 3%. That's a really fine point and a differentiated view. And speaking of other differentiated views, we got the economic environment, but let's talk about what do you do about it. And I know there's a lot of tactical trades that are constantly being implemented in the portfolio. One of them is about rates. How do you feel about rates and where rates headed in this environment?
Yeah, you're right about that. One of many tactical positions we're running right now is a pretty bearish view on developed world bonds, especially in the US. Now, part of that relates to some things we've just spoken about. The last mile of disinflation could be a lot harder to come by than the first couple miles worth. That could constrain the Fed from delivering all those interest rate cuts that are now priced into the bond market for last year. So some typical, let's say, macro reasons for being short bonds. But I think we wouldn't be this bearish on bonds if there weren't also a big supply problem looming that I think is underappreciated. It's pretty amazing in the last year or so that the federal government could run a 5 to 7% of GDP budget deficit and issue very few bonds, issue very little duration into the market. And the way they pulled off that trick, run a big deficit but don't issue many bonds, is they just spent down their cash. And then when they did issue debt, issue lots of T-bills and not that many bonds. That's about to change. They've just announced that that's about to change. And I think that when we look at the lineup of prospective buyers of bonds and what kind of environments motivate them to buy bonds, there aren't going to be enough buyers to handle this sharply increased supply of Treasury bond issuance that's coming. Now I put that next to some of our economic views, and it's kind of like all the stars are lining up to a bearish bond bet, which, as you said, that's one of the bets that we really like in the portfolio right now.
With rates, by the way, going from 4% on a 10-year to, what do we think?
Oh, I wouldn't be surprised to see a 5 at some point in the next year, sure.
Yeah. Okay, well, now you got me really worried because, for years we've been getting a lot of questions about the U.S. budget deficit and also things like what if Bank of Japan, widens its interest, its yield curve control, and they have higher rates in Japan, what's the knock-on effect on U.S. Treasuries? So you put all that together, and that's why the view might actually be accurate that we might get to 5% rates. Okay, I'm worried now, but there's something else that I know you're worried about and people don't talk about. So tell us what that is.
Yeah, I think the big thing all investors should be thinking about, even if it doesn't turn out to be a next 12-month thing, which is certainly possible, is what do you have in your portfolio that can do well if GDP starts to turn down, to turn negative, but interest rates don't?
Right.
I don't know if we're going to find ourselves in the next year or two in that world where the economy is becoming very weak, the unemployment rate is going up, but the inflation rate's not low enough yet to allow the Fed to come riding to the rescue. It's probably been 40 years since we lived in a world where GDP went down but interest rates didn't, because central banks were constrained. And that's a very dangerous sort of environment for traditional portfolios that while it's never happened in our lifetimes, investing lifetimes, we know it can happen. And we think there's certainly enough risk that it does happen again, that it's worth combing through portfolios line item by line item and saying, what do I have that could work?
Right. Well, speaking of risks, just real quick as kind of the last thought here, one of the risks that you think investors should be thinking about is not having enough diversifying assets in their portfolio, and that means not having enough alternatives. So add a little bit more to that.
Yeah, I think where alternatives come in is very much through this sort of scenario analysis planning that we were just talking about. And I think if you use alternatives to obtain things like more exposure to inflation hedging assets in case that last mile of inflation does prove to be a problem down the road, or absolute return. I think within the world of alternatives, there certainly are managers and strategies that can be short as often as they're long, do a lot of relative value trading. And if you're truly unconstrained, I can be long or short or do spread trades and relative value trades. Those are all examples of strategies that have a good chance to still make money, even if we wind up in a much more difficult sort of economic environment.
Right. Patrick, thank you so much. This has been fantastic. You certainly gave us a few things to worry or at least ponder, whether it's constrained central banks, but you certainly give us, a lot of comfort knowing that there is a toolkit that is unconstrained, which relies on long trades, short trades, and also relative value trades. And all of those you look at all the time at Bridgewater. So we thank you so much for that and sharing your out of consensus opinions with us. Thanks so much.
Thanks. Love being here.